Welcome to the Liquidity Detective. This video is for educational purposes only and does not constitute financial advice. Past performance is not indicative of future results. All trades shown are real, but your results may differ. Now let's look at what the market was doing before I placed this trade. On June 1st, I bought this stock at $73.91. 16 days later, I sold it at $77.63. The trade returned just over 5%, but the real reason I entered had nothing to do with June 1st. The signal happened 3 weeks earlier, when millions of shares changed hands near the lows. Here is what Liquidity was doing before I ever placed the order. On May 8th, this stock broke through support on nearly 5 times the average daily volume. The bar opened at $78.61. It dropped to a low of $73.81, and it closed near the bottom of the range. To most traders, this looked like a breakdown, a stock falling on heavy volume, through support, closing near the lows. The obvious read was, sellers in control, but that is not what the volume was saying. For 5 months, every rally failed. By May, traders who had bought the prior lows were trapped. The last major swing low was all that stood between them and their stop orders. When price finally approached that level in early May, the pressure was enormous. May 8th was not a breakdown, it was a stop hunt. Below that swing low, stop orders had been building for months. Those exits were clustered in one place, just beneath the level. That level was not a floor, it was a target. When price broke through, it moved exactly far enough to trigger those orders. Then it stopped. 3 days later, the picture shifted. On May 11th, the stock opened at $75.27 and closed at $78.52. Volume was still 3 times the average. Price closed at 85% of the day's range. Despite the selling, price immediately recovered. The sweep is not the signal. The response to the sweep is the signal. This is the part that most traders would act on. The panic is over, price is recovering, and this is where most traders would have entered. I didn't. After the recovery, price climbed back toward $79. Then it pulled back again. On June 1st, price returned to $73.91, nearly the exact level of the May 8th sweep low. 3 weeks after the panic, the zone had already been tested. It had already held. I was not predicting a bounce. I was entering a level I had already watched get tested. On June 17th, I exited at $77.63, a 5% gain in 16 days. Then this happened. The next trading day, the stock printed another 5 times volume sell-off. Had I stayed in the trade, most of that gain would have been handed back. I did not know that would happen when I sold. I exited because the trade I had identified was complete, not because I predicted what came next. Liquidity does not predict the future. It identifies locations where risk and reward shift. In this trade, the sweep came first. 3 weeks later, when price returned to the same zone, the level had already proven it mattered. The signal wasn't on June 1st. It wasn't even on May 11th. The signal happened the moment the market failed to continue lower. If you want to see more trade breakdowns like this, subscribe. The next one is already on the chart.